Funding for the Stoller Report is made possible by a grant from the First American Title Insurance Company of New York. The First American Corporation is the nation's leading diversified provider of business information products and services that impact the major events of people's lives.
Hello, my name is Michael Stoller, the host of the Stoller Report, Real Estate Trends in the Tri-State Region. The topic of today's broadcast is office buildings, industry leaders' perspective. My guests include Mitchell Hirsch, CEO and President of Mack-Cali Realty Corporation, Robert Wise, President of the RPW Group, Richard Kessler, Chief Operating Officer of Benison Capital Partners, Todd Waterman, Executive Vice President of Rex & Associates Realty Corp., Adam Popper, Managing Director of Beacon Capital Partners, and definitely last but not least, William Macklow, President of Macklow Properties. Everybody wants to own office buildings. Everybody wants to own their apartment. Everybody wants to own residential. Everybody wants to own a piece of retail. And everybody wants to own an office building. Everybody wants a little medical office building. Everybody would like some part of an office building. And you have the opportunity. You could buy a small little building in Brooklyn, or you could possibly buy an office building in Westchester as an individual. Perhaps you can do a partnership with a couple of people. Or you could even possibly buy the stock of these two individuals, of their companies, because they are REITs and they're publicly held. But why does everybody want to own office buildings? Don't they remember that there were vacancies and the world changes? What's the problem? What are the pros and cons? Why does a company like you, I mean, I'm sitting here with 6 people who control 85 million square feet of office space. That's an outrageous sum. Why do you like owning 35 million square feet of office space, Mitch?
Well, I particularly like it because our buildings are generally located in high barrier to entry markets. And so
for my audience, what is a high...
an area or a region or a market where it's very difficult to add new supply by virtue of constructing a new building, and that's created from a variety of different perspectives, partially because of the constraints on land availability in the northeastern part of the United States, particularly the metropolitan New York marketplace, the metropolitan Washington marketplace. It's partially because of the regulatory environment, environmental constraints, constraints on infrastructure, traffic, that sort of thing. And so it's a very costly, time-consuming process in order to add any sort of new inventory in the marketplace. In Manhattan, it's even more difficult, and I'm sure others can talk to that.
So for my guests and for my audience, you own 35 million square feet of office space, basically in the suburbs. I mean, with the exception of Jersey City, which is our neighbor across the river, Westchester, Stamford, Washington, New Jersey, all parts of New Jersey. Now, Robert, you like Westchester. I mean, that's a market that you've been in since 1979. How do you get into the office building market, and what do you see? What intrigued you to get into the office building market?
Well, originally we were in the furniture business, and we entered the real estate market, really buying warehouses for my furniture company. As the years went by, and we started buying other properties, we bought office buildings. And we started buying in Westchester, not really in '79, but in '89. So we've been there for 17 years.
So the website said 79, but it was really 89.
Well, '79 was New Jersey, really. So the website maybe is not completely clear. We like Westchester. We think it's a great market. And frankly, we think it's a great market because it's been a very down market for many years. Westchester is probably one of the worst markets in the tri-state.
I mean, Westchester, for my audience, for a period of close to 20 years, there hasn't been one new building.
That's right. There's been no new buildings.
And in the mid-'90s, perhaps we had close to a 30% vacancy in Westchester.
Downtown White Plains at one point had the highest vacancy of any major city in the country.
And look at it today. I mean, but what's happened to downtown White Plains, as opposed to new office buildings, we have mostly new residential. But we're not talking about residential. Todd, Rexon has property in Westchester, Long Island, New Jersey, and you really spearhead, besides development for the entire company, you spearhead Manhattan. Why do you love Manhattan so much?
Well, I don't think it's necessarily a question of loving Manhattan, although
we all do. But I'm just being a little.
I am a native New Yorker and was born and grew up in Manhattan. But I think what Mitch said before about barriers to entry really holds true for the Manhattan market more than any other. I mean, this market as a real estate marketplace for 100 years was really owned and dominated and dictated by families like Billy's, and you know.
So you and this gentleman became the evil stock companies who bought over properties from nice people like his family, people.
Well,
like
he's not nice. And he's evil, but I'm not. Okay?
Oh, I knew it was the wrong side of
it. Knowing both of them the way I do. But no, I think getting...
That's what happens when you go to the fights with him in Atlantic City.
This is true, and other things. But I really do think that what holds true for the markets that we're all in is the fact that these office real estate assets over long periods of time have proven to be very resilient investments. And if you're either an individual or an institution and you have money to invest, you make asset allocation decisions. And allocating some of your assets into New York City, Manhattan, or the tri-state has proven to be, since the time of his grandfather, you know, a great...
No offense.
No, but first my grandfather was a textile salesman.
Who
Okay,
got
so
it
we have to
go to the right history over here.
Right. So I think I'm going to chime in here because you're asking really why everybody likes office buildings, why they want to own office buildings, and it's a multi-tiered answer here. So if you want to set your watches, I'll begin to respond to that a bit. First of all, I thought everybody wanted to have a hedge fund, but we can get back to that in next week's
episode. Or title
episode.
Insurance business.
Or title for that matter. And at least for me, in terms of the concept really of why I like owning office buildings is, you know, it was a family business. My dad did tell me I was unemployable elsewhere, and as a result of that deleterious effect on my self-esteem.
Wait a second. Your dad was a leasing broker with Julian J. Studley.
My dad started as a leasing broker at Studley and grew very quickly. He actually outgrew Studley.
No, I know.
At the time, because Studley was a nascent firm at the time, and Dad was terrific. He's, you know, super smart, very aggressive, and he was able to do a lot of leasing deals. It was funny, and he rented up most of the Pan Am building, and a year ago when we were one of the finalists bidding on 200 Park, you know, we were looking at the rent roll, and Dad remembered making leases there at $4 a year. So the comment of cycles and timing and growth, when you're looking at least an offering memorandum as prepared by the selling broker forecasting rents at $100 a foot 40 years later, you know, is a 25 times growth multiple over 40 years something worth owning? Sure. Why not?
You know, but let's look at this. I mean, for my audience, people who don't know who Billy Macklow and Harry Macklow are, in 2003, you paid at that time the highest price for an office building in America. You paid $1,450,000,000 for the GM building.
I read about it, yes.
Yeah, I read about it too. And I believe in 1998, Conseco, the insurance company, and Mr. Trump, he only put $11 million, but that's what he normally puts in, very little. They bought it for about $800 million. Correct. So you bought that building, at the GM building, which many people said, we want to have the mortgage because when Harry and Billy lose the building, we want to own the building. to everyone's chagrin and to everybody's happiness, because a lot of people in the real estate industry like to see failure, but they really are a team. They roll a family into this. The building has become a great success, even better than it's been. You've recapitalized the building with the Jamestown, with the Germans last year. And, you know, the New York market is hot.
The New York market is hot, and I think to our investment focus, perhaps different than my colleagues sitting right here this evening, is we are solely Manhattan. And I think that does speak to the point about barriers to entry and the different ways one plays with capital. We don't have the currency of stock of a REIT to do that.
But Robert is an individual running in Westchester. Okay, Adam is a fund based in Boston.
But Adam's also opportunistic. You look outside Boston.
Right.
And Robert said he started in New Jersey, so they take very focused approaches to their real estate. Rexon is an agglomeration of several different companies that dominated their regions. Mack-Cali is the result of a merger of also two regional companies that dominated within their
and
markets.
A recent acquisition of the Gale companies.
Yes, which was also another private force in that marketplace.
The question comes in, you know, it was 2001. In let's say 1999 to 2000, real estate, I mean, offices were doing great. There was something called the Committee of 35 for the people in New York City who remember it, and they say we needed 15 million square feet of new office space. And then just before the tragedy of the World Trade Center, the market really was collapsing. I mean, it was hurting. It wasn't collapsing. And then unfortunately for some owners, 19 million square feet of space left the market in Lower Manhattan.
I think you have to take apart the statistics of the market is falling or the market's not falling. The market also at 2000 had rushed to meteoric heights and had a velocity heretofore unknown and unseen in our marketplace, really driven by the dot-com explosion. And after a certain point, all the tertiary buildings that typically command $20 or $30 in rent were now commanding $50, $60 a foot, pushed the dot-coms into traditional office marketplaces such as the Grand Central District, the Plaza District, and it changed the dynamic.
And then the dot-com, I mean, Mitch, I mean, you had Jersey City. Were the dot-coms in Jersey City?
Well, to a very limited extent. First of all, I think, I don't know if the market was collapsing, as you
I'm
said.
not saying collapsing.
I think the economy
was
beginning to falter 6 months before 9/11. And the tragedy of 9/11 certainly created, you know, the cataclysmic event, and it changed the dynamic. And that, in conjunction with the implosion that occurred in technology and the internet and the insatiable need to add jobs to support those industries, left a lot of vacant space in the market. Many of those buildings that had been leased were really functionally obsolete, and it created a flight to quality, which benefited higher caliber real estate in all of our markets. And so the whole dynamic of the market changed. We, as far as I am concerned, but for the insatiable amount of capital that's entered the system through both domestic and international sources to buoy the investment sales market in real estate, the benefit that Manhattan has had has been the barriers to entry. It is, in fact, the financial capital of the world.
But but you have companies in Jersey City, major financial companies who have gone to Jersey City.
Right.
And in the 80s, the late 80s, Chase went to Brooklyn.
Right. Well, I think companies became more cognizant of issues that surround cost of occupancy, demographics, the ability to attract labor from a variety of different sources, have accessibility, have affordable housing that their employee base could draw from. So dynamics began to change, and thus the competitive landscape began to change.
But in 2000, leading up to 2000, the stock market was a much more viable, much more attractive alternative investment than investing in office buildings. And people made a lot of money, made multiples on their money very quickly in the stock market. And real estate began to follow as a result of what was just said about dot-coms growing, moving into secondary and tertiary office buildings, increasing employment count, and therefore absorbing office space. Office space became, as people couldn't find space in primary markets, they went to secondary and tertiary markets and discovered those markets. Those markets started to get buoyed by the fact that people started to go to those markets. Residential started to follow those markets, and now, you know, when the stock market crashed and the whole landscape of investing was kind of turned upside down, and people lost hundreds of millions of billions of dollars were lost in the stock market, real estate became first a safe investment and now became an opportunistic investment. And now is, you know, couple that with, you know, historically low interest rates, and you have kind of a confluence of events.
Right, but interest rates today have really adjusted. I mean, you know, at one time the money market rates were low.
Yeah,
I
but
mean,
Michael, where have they adjusted to?
Right.
I mean, you
They're
have to
still
look.
at historic
They're still
rates.
They're still.
You know, I would say what
10%.
goes to your point is if you look back in the 2001 timeframe or 2000, when the hot money was in technology stocks and internet stocks in terms of the capital market activity, real estate fundamentals were much stronger than they are today and that they have been over the last couple of years. Yet the publicly traded companies and the stocks of our publicly traded companies were underperforming. Even though rents were high, occupancies were strong.
I don't know if I agree with you that the fundamentals then were better than they are today, at least speaking from my marketplace.
But for perhaps the recovery in Manhattan, Midtown Manhattan in particular, I would say most other markets throughout the country were much stronger. Certainly if you look at the 2001 to 2004 time frame.
Well, isn't a bellwether statistic of that equity office properties?
Well,
and how they're on a
and the
de-accessioning
speaker
program
right.
and getting out of all those
you know, but you
silly
know,
markets?
for my audience, okay, Mac Cali, you were with a Mac company. The Mac company was a family business
Right.
in many cases, owning a significant portion of real estate in New Jersey and some in Westchester.
Right.
And then you merged in the early 90s with a public company, a REIT, the Cali company.
In 97.
97, and you created Mac Cali,
Right.
and then subsequently you acquired Robert Martin, and
Right.
so on. Rexon was a private company
Yes.
who became a public company when?
95.
In 1995. And then in 1998, okay, there were really the first big, because REITs hadn't really come to New York City that much. In 1998, Bernie Mendick sells his company to
Vornado.
and he gets $650 million. It didn't matter what he got, but that was, and there was an article in the New York Times at that time saying that the REITs are going to come to the marketplace, and the families, including the Benison Capital, and we discussed this prior to the show, and the Maclaus, and the Rudins never wanted to do it, or the Durst, that's what the article said, and I've spoken about them, that all of the families and all the companies who've been around, and I'm going to throw to you in a second why you don't become a REIT, all were going to become REITs. Why was everybody why did everyone...
We weren't actually going to become a REIT. We explored the idea because it was a prudent thing to do to see if that was a strategy that we should entertain, and we dismissed it very early. That it was not something that we wanted to do, to go public, to open up ourselves to the outside, to the outside world. That we thought it would be a great way to access capital, but the way that we would have to change our business strategy and have shareholders and be beholden to them and not be able to make decisions and do things, we dismissed it. The other reason is that at the time the capital markets didn't really value us, give us any entity value. And
I think that's a key point, because you had asked before the cameras came on what our experience was in going through the whole registration
Right, because
process.
Adam at that time was with Woodcoff, and they were thinking of going public also, and so I mean
it was the same time, and Lehman was courting all of us, and it was a very exciting time.
And you were going to have all the stock.
We did a joint venture with Woodcoff and put an asset together just to go in because we were going to get OP units in his REIT.
Well, the whole point of the currency of the OP unit for the uninitiated viewer is a tax-free transaction where you can sell and monetize your real estate without having a taxable event until some point in the future.
It's a deferral of tax.
It really is, but
But as you said prior to the show, it was a good situation because for an estate planning purpose,
It deals with legacy and estate planning.
Right, there are
It's
two
great for
reasons.
estate
There's
planning
this-
and roll-up.
Right.
And
Oh,
if you are
capitalization.
if you're a partnership-based entity, and I'm not talking about S corps business, but if you really take different investors as partners, and everybody has different wants, different requirements, distributions, they want to be in, they want to be out, how it happens, and ultimately what you as the control person want is a desire for the asset. Rolling it up into a REIT is a very efficient way to achieve many a means to an end.
But essentially, it's, I mean, after estate planning, it's really, you look at the public execution as a way to either rid yourself of debt or access additional capital.
But you know, in the stock market, for the last 7 years, if somebody owned a REIT, REITs were the best investments on the market for seven years in a row. This year, REITs have been doing great.
The total returns between dividends, which are significant, and capital appreciation
supposed to
has
give away 95%.
outperformed the
Any
S&P by
other sector.
wide margins over the last
In
number of years.
addition, they are very tax efficient vehicles, even for investors, because a portion of the dividend on an annual basis is typically
Capital gain.
some return of
Well, not
capital
return
or
of capital, but
or capital gain. And you know, the other thing about being a REIT is that there's no rule written for companies like Mitch's or ours that says that we can't do all the things from a capitalization standpoint that private companies do.
Right,
But you're under a little bit more scrutiny, right? Quarterly, someone's going to ask you what you're doing, and you can explain it or not explain.
Yeah, but you know, Robert, you own. I mean, last year, or it was a year and a half ago, you bought what people would call the Taj Mahal of Westchester. You bought the former Kraft Foods Atria headquarters, which was completely vacant. You paid $40 million for it. You had a nice union insurance. Union Life came over there, and you've turned it. I mean, you've made it great. I mean, it's 100%, close to 100% leased.
Almost 100.
Okay, it's almost 100%. Here's the situation. This man could give you stock, or this guy could give you stock. And that stock could give you tax good events that you don't have to, you can defer income. You can be a large shareholder. You might be able to run your own region. Have you ever thought of being a REIT?
Well, frankly, I think there is value to investors like myself to have full control of our operations. So there is another side of this coin, which is the fact that the REITs do have to respond to a number of entities that we don't have to. And we certainly have the flexibility to move in ways that maybe REITs can move, especially in a market like this where capital is so available, where financing is readily available. For companies like my own, to be able to operate with practically total freedom, to be able to structure our purchases as well as the regions we want to go in function of how we feel like, without any type of restriction, I think there is a great value to that. So in my specific case, we have no interest in becoming a REIT or becoming part of a REIT.
Billy, as I was saying to you, so it was 1998, and you and Dad were thinking of becoming a REIT. What happened?
We went through the whole exercise. We were never 100% subscribed to the idea of ultimate execution. We finished everything prior to the summer holiday. That summer in 1998, the perfect storm that hit the financial markets, there was the collapse of long-term capital management, a Russian debt crisis, an Asian flu, and this shut the capital markets down. It was truly violent. At the same time, the fundamentals, rents, absorption, values kept increasing. Yet there was the bankers were gone, nobody was there. The capital markets ultimately corrected themselves. And during this period, the end of the summer, when things kind of calmed down and we were getting ready to prepare for our road show, we really looked at what our valuation was and what our peer group was. Our business, according to our bankers at Lehman, would be peer grouped against Boston Properties, equity office properties, very nice names, very strong company to be with. However, those companies were trading at 9 or 10 multiples. Now, our private value as a real estate company, this is before we went into the cap rate compression that our industry has enjoyed over the past 2 years, was probably 200 or 300 basis points ahead of that. And that's something that really comes out of sponsor equity. That's your money. So the value decision to, as Richard really points out, put yourself under that scrutiny, especially when we as a company really don't work with partners. We didn't have roll-up risk. We weren't confronted with estate planning issues. We wanted the ability to be free to conduct our business as we see fit. Exactly what Robert's saying. Our model is much better designed to be private, especially when you look at the valuation issues. I've spoken several times publicly about this issue, and I really feel, and you know, I'll punt it back to Mitch and Todd after this. I don't think Wall Street fully understands real estate cash flows. I don't think the appropriate and fair valuations are put on office buildings by real estate. And I think that's certainly demonstrated today, notwithstanding the fact that we're in a frothy market of, like I said, compressed cap rates and very high values. The need for REITs to make acquisitions on an accretive basis absolutely exists. Otherwise, you get pummeled by your analysts unless you are of such an asset value and a portfolio of a Vornado size or an EOP size where long-term turnaround strategy plays can be buried.
You bring up the question, the point. 1998, Jimmy Kuhn, who's president of Frank Newmark, they changed their name now, talking about the REITs, and this is before the long-term capital, said, it's also not clear that analytical skills designed to evaluate industrial and commercial companies can be successfully applied to real estate. Some people in the industry say, I don't think Wall Street and the analysts have the ability to distinguish between a good deal and a bad deal, said Jimmy Kuhn.
He overheard me talking at a bar one night. It's terrible.
Well, let's call a timeout here for a second, okay?
We're going to get off the REIT subject because we have to talk about office buildings.
I think that what I would say is that in 1991, you could buy Citigroup stock for $9 a share, okay? And did that mean that the enterprise value of that company was worth that?
But you guys like Citigroup. I mean, you just bought a little building last year.
Okay.
You know I was going to set that up.
The point I'm trying to make is that what everybody's saying here has some validity. The bottom line is we're in two different businesses. And we have a situation where part of the value, as Mitch said earlier, of our stock price is beholden to funds flow and where investors choose to allocate capital at a given time. But over the long run, I think, you know, there is a correlation that is not that distant between the private and public sector in terms of values go up and values go down.
Right, but here, let me just make a comment in response to Billy and Todd. The private markets have had an advantage over the last couple of years because of the fact that in a low interest rate environment with the ability to employ significantly more leverage than we can in the public sector, you have a distinct advantage.
I don't disagree with that. But I also I know you want to move on, so I'm going to try and throw one last comment here. Every form of real estate now, whether it's the real estate that our friends to my left here participate in or we participate in, is now public. There is no more balance sheet lending. Everything is a CMBS product, everything is securitized, everything goes to the public markets. So in a way, we are all brethren of a kind. And the money is out there, and the risk, whether it's owning a stock, whether it's owning a bond, however the risk happens, it is spread into a public forum.
But, you know, besides that, you know, we're in today's market, last year, Adams Company bought 237 Park Avenue. You paid approximately $500 a square foot for the building.
Well, you made an investment,
Made an
right?
investment.
So you made an
That's
investment,
fair.
90%.
Right.
Okay,
Right.
you made
Well,
a 90%
90%
investment. Right next door to you is the Hemsley building, 230 Park Avenue. And the individuals from Dubai decided to buy the property at a price of probably close to $800 a foot, with a return of less than like a 4% return. So you have, in addition to the REITs, in addition to the regular investors, you have these people from Dubai, you have other investors over there. There's a lot of people looking, everybody wants to buy this real estate, and my question is, which markets are really good? I mean, Robert is buying a property from a Salt Lake City church, the Mormon Church. You bought a property from Kraft last year. You own property in Stanford. You were just talking about Citigroup. Last year you bought a building that I called, prior to the show, the Jolly Green Giant in Long Island City, you know, which was built in 1989, that no one was there, but you had a great tenant, Citigroup. Adam, besides 237, buys 100 Wall Street. And guess who he bought it from? You. You know, there are buyers and sellers for everything. My question is, where do you want to buy? Where do you want to sell? What do you think of the different markets? And people are always interested. People stop me in the street and they say, "Where's the best place?" I got the experts over here. I'm just the moderator.
The answer to that is that, in all of our different acquisitions, we believe that we see something that the seller has left on the table one way or another.
Are you saying, my friend, Mr. Waterman?
I can't believe you sat them next to each other.
No,
I mean,
no,
really.
I'm not saying.
I know, because the two of you are too close. That's why I needed
Todd and I
to.
know each other for a long time. Todd's business plan is different than my business plan.
See,
Todd
So
has an
you,
operating
so
plan.
wait,
the evil
wait a
one.
second. So you went into Lower Manhattan. You have one of the few buildings on Wall Street that is still an office building.
Right, but I don't have.
And this man has no office buildings in Lower Manhattan. 610 Broadway, I don't consider Lower
610
Manhattan.
probably doesn't count.
It
It's a
doesn't.
one-off. It's a different asset. And I won't invest in downtown.
Why won't you?
I don't like the market. I think that market suffers a worse north-south economic relationship than does Jersey City, than does Westchester.
Jersey City, please. This
No,
man owns a lot of property.
He's supporting
Oh,
it.
he's-
I'm supporting that.
Oh,
That's what I'm
okay.
saying. I'd rather own a building there. I don't like the marketplace. We've never been there. We believe in focusing our core office portfolio
In Midtown.
investments in the tried and time-tested locations, Grand Central and the Plaza District.
Goes
That's our
it
focus.
goes back to the quality of the asset. I said before, flight to quality. Every cycle has flight to quality.
Down the last, first to
And
come back
be
up.
in markets where there are constraints to new supply.
But everyone here also has a different platform by which they're operating, right? I mean, some companies here are
this
public companies,
gentleman,
some
you know,
are
from
private
the
companies.
furniture business to have 2 million square feet and to buy and sell and trade properties, he likes Westchester.
Right,
And
but
they-
he
they-
likes Westchester because he sees value
Right.
when other people don't.
And your time horizon might
And
be
my
different.
time horizon is different. I buy properties
And look at
with
Rich's
no
time
no
horizon.
operating.
They have no time
We have
horizon.
no time horizon, and the other issue is that we don't have any we don't have to put capital out. We have no obligation to buy anything. We have no investors. We have no shareholders. We have ourselves. So we can be very, very selective
You
and
wait
look for
for the deal that
opportunities.
you like.
And we have 200 assets in 42 states that we have enough going on, releasing, repositioning opportunities that we can be very patient and only go after opportunities that we really believe in, and don't have to go after anything.
If
But
it's a
everyone has
great
a
ski
different-
season, they don't buy a building till June.
Right. And Billy has a great niche market, right? Class A boutique buildings in Midtown Manhattan. That's a great
I
platform.
mean,
That's a great
even though they
strategy.
didn't, even
They're
though they
not
didn't get,
necessarily boutique.
I wouldn't call
but-
it GM
I
building,
would
but-
call, I would call the GM building probably the premier building
I don't mean
in New
boutique
York
by
City.
tenant size. I mean boutique by the fact that it's at the top of the market. It's a white diamond, right?
But
It's,
look what he's
boutique
done.
meaning-
He's done something great. How many people own the GM building? And I remember as a kid going to a restaurant there. That's
The Auto
called
Club.
Auto
Auto
Club,
Club,
right?
the
cars-
And that no one is able to see the value of the retail there or capitalize on it until you bought it, and you're taking advantage of the value
Right,
of the retail.
you went to the sidewalk.
You
I
saw
mean,
something different that other people didn't capitalize
But
on.
I think that's what Adam is saying about his investment
stays out
focus.
very
and what
late at night.
Well,
and has visions.
and every now and then, some of them don't get me in jail. But no, I think it's you know, that's what Adam's saying. I think people thought we were a little, and thank you for the compliment, Richard. I appreciate it, because I think people didn't understand what then seemed like a lofty price for acquisition. And we had a very private vision of the asset, what we could do with it, and renting the office space was the academic component of the deal, because that's what we're supposed to do. Bringing the value, adding the retail, expanding that was our niche, was how we were able to turn that building around.
And you know, in a similar matter, what Robert, you went a building that was totally vacant, I mean, with a man-made lake, two buildings really, and it was a difficult configuration. How do you make that decision in a different, I mean, this is the Plaza District. This is, you know, this is the prime Manhattan. And you went into a neighborhood which, as Mitch owns a lot of property in that marketplace, Rexon owns a lot of property, you went in there, could have been a really dangerous move.
Well, it was a very unusual building, and it was a building that seemed to be very difficult to subdivide. But I think what we are getting to is, even though we are all in the real estate business, what makes a difference in terms of why he will sell and he will buy is the business plan that is behind it. So we can look at the same building and see a completely different structure than the way he will see it or he will see it. So you have a great example of how a very clear building that has been there for many years, the GM building, everybody had the perception that this was going to be a failure and ended up being a great success. Why? What changed that building that turned it into a tremendous success? The vision and the business plan behind it. So the same thing can happen with 100 Wall Street, and the same thing happened in the case of Altria building. No. It was just, what was the concept behind? The building didn't change. The use, the nature, and ultimately the return of the building changed dramatically based on that concept, that business plan behind it.
I think, you know, prior to the show, I was talking to Todd, and we were talking about repositioning.
What about 1185 6th?
That's exactly.
Rexon stepped up.
1185 6 and
had
1350. Why don't you tell us about those two?
You had a bankrupt anchor tenant, you had a complicated ground lease situation, and you had a challenging market at the time.
Yeah, I think that every person sitting around this table works for either a large company, mid-sized company, or very small and entrepreneurial. And all of us are involved with major projects from time to time. And the real key is, how much time does each company have to focus on an opportunity? And that's where you really have to pick and choose. And sure, we've done it, and we've done it in many different markets over many different years, and most of the people around this table have done the exact same thing. You've got a unique group of people here that either own themselves or work for a company that own very valuable assets. The ability to see something, as Robert said, is a function of your organization's talent, your organization's time, and your capital structure. And all the things have to come together.
But I would go a step further. Robert can take advantage of an entrepreneurial activity. He doesn't need to build a franchise or build a brand. He needs to see the possibility of an economic return. We're in the business, in part, of having a strategic vision of brand building, name recognition, and focus. If we were to do what he does and buy a building in every state in the country, we would have very few shareholders.
Right, and what you did, what we discussed, you had two buildings in Long Island, and you said it wasn't the market for you, and because you were concentration
and no competitive advantage. And so I took advantage of the lofty pricing.
Right, and you were the gorillas out there.
Marketing and branding. We focus on marketing and branding. And with our core holdings and the way our buildings are there and with the audience we target, it's very important to do that. Real estate is not an advertising-driven vehicle. Our advertising is primarily broker targeted, and that's it. It's awareness. And you want organic growth. I want to renew my tenants. I want my tenants to tell other people to come in, because like a retailer, it's the same concept as same-store sales. Are you improving? Are you doing better?
But you brand for a different reason, right? You brand so that tenants understand consistency, whether they be in a residential project or an office building, right?
Yes,
I mean,
but that
you open
all,
up an ad in
but
Cranes
that,
and everyone knows that it's the Macalab before they read its building.
Absolutely, but that translates to the financial community. It translates to lenders. It translates to investors.
Right,
they
but
see a point
when
of view. They
somebody's going to
see
buy
a
a
vision.
real estate stock, be it Rexon, Mac Cali, or whomever, you want them to very quickly understand what the strategy is of the company, and if they are determined to buy Manhattan-centric properties because they like the diversity, they like the strength of the markets, et cetera, they're going to have certain choices that they can make. And that's a very large part of the being in the public sector.
But isn't that an interesting question then about SL Green leaving their core focus of B buildings and taking C buildings and trying to buy more A assets in A neighborhoods?
Yeah. Well, SL Green also has a structured finance element to it, so that gives them certain other latitude.
Well, so does
Renato.
I mean,
as a private company, we have a brand that we're interested in also. And we're a 100-year-old company that we have a certain quality reputation, and that's what we're selling. We don't have a product strategy because we do a lot of one-off transactions in a variety of markets,
Well,
and we can do that. And we have the flexibility to do that.
But really, the big difference is who's the audience. Billy told us who his audience is, but Mitch and I have a completely different audience. And the thing that I think maybe for your audience that may be interesting is that we're sitting, you have 6 guys in suits sitting around this table talking about 85 million square feet, as you put it, of Class A office assets that are worth untold billions of dollars. But for the average viewer who may be intrigued by this concept, well, how do you participate in that?
I think it's a participation on the REIT opportunity, but it's also the participation, I think what my viewers would like to get is where you people see the different markets. I mean, we know that you really left Lower Manhattan because you didn't have another product there and you felt it was probably better, I don't want to speak for you, but it was better to be in Midtown. Billy just mentioned that they never liked Lower Manhattan, and you'd never be in
Rexon also got that building through an acquisition of another REIT. That was part of Tower Realty. Right. So they might never have bought the building if they came to New York in a different fashion.
The same way Tishman acquired certain properties, Lower Manhattan. My question that I really want to get in the next couple of minutes is I really want to, people say, what are the different markets? We have Lower Manhattan, Mitch has Jersey City. There's some magnificent buildings in Jersey City. There's new residential in Jersey City, as opposed to Manhattan, where the minimum new building is $1,000 a square foot for residential, and your new building at 310 East 53rd, a magnificent building.
Thank you.
I mean, $1,000, you can't even get the second floor. I mean, that would be too low. But what is Jersey City like? People hear about it. Unfortunately, my show is only in the 5 boroughs, but a lot of people watching the internet. People never knew about Jersey City, and Jersey City really is a great marketplace.
Sure, Jersey City emerged as a back office location, and it has evolved, and there's been a renaissance where it now is a very strong corporate culture as well as an evolving sense of community. It's got great transportation. It's a very affordable alternative to Manhattan in terms of the cost of occupancy for commercial and office space. And its amenity base is growing very rapidly. If you combine that with the availability of housing and the transportation access, it's a very credible market.
And somebody can get an office for $29?
And post 9/11, with due respect to the horrific tragedy, companies, particularly downtown-centric companies, have begun to rethink some of their occupancy and their space needs and how and where they house their employees and the kind of diversification and distribution of workforce that they might want to consider in the unlikely and hopeful event that we ever have a similar type of tragedy.
But you've had a confluence of both tragedy and opportunity, right? Because in the wake of tragedy, there were financing opportunities, and
that's the way of the world.
Right.
I mean,
Yeah, but I think Jersey has grown steadily after everything came out of the overhang of the 80s into the early 90s. Jersey, you say you're only in the 5 boroughs. I think there's certain elements of Gold Coast Jersey that I would really refer to as the far west side. I mean, West New York, Weehawken,
Right.
Hoboken have taken on, they have restaurants, they have a single scene, young people priced out of New York.
How do you know about all that?
You know, I've read about it in strange magazines. and
What's
things
on our
like that.
website?
It was on their way to Atlantic City. They
You
made
went
all
to their
stops.
website. No, no.
But he's right. There's a sense of
He is right.
community.
But a lot of that's driven. I mean, a lot of that has become driven by the fact that, you know, moderate affordability of housing has really kind of left the city. I don't want to go on a residential conversation, but I'm just saying that's helped sustain.
But you know what?
and build other.
But I'm sitting here with one person who's in Jersey City. Now, Rexon, do you have anything in Jersey City, or have
Mitch
you?
won't let us
they
in.
tried.
We tried,
They
but Mitch
tried.
won't let us in. Okay.
You mean the barrier?
I'll
the
stay out of
barrier,
Long Island.
the-
You stay out of Jersey
Right.
City.
The answer is no, we don't.
Why
and
not?
We have not. We've taken a shot at a couple of assets that we thought were premier assets, and we were outbid. And I think that when you ask what are the best markets to be in, I really would answer it in two ways. The truth is that everybody around this table are in great markets. And depending on what your interest is as an investor, what your real goal is to find the real estate operator or sponsor or fund manager that is the best at what they do in the particular market that you're interested in. And in certain cases, the companies represented around this table compete in some of the same markets, and in other cases, we don't compete.
I mean, Robert was named the landlord of the year in Westchester last year, and Robert has, you know, a significant number of medical office space, probably one of the largest medical, with the exception of hospitals, in Westchester. Adam, you know, Beacon is only in New York now for a short period of time. You already have two prominent investments, and I think the 100 Wall Street investment, having a Class A office building, while many of the buildings have been converted, and if you want to be in Lower Manhattan and you want to get a good rent, it's a great deal, because you can get how much is rent in 100 Wall? An idea, just in range.
Mid-30s per square
So
foot.
it's mid-30s, but there are incentives. How much is rent?
Same thing.
Mid-30s in Jersey City. How much is rent in Maclow's building at 340 Madison or 540? I looked at the.
It's the same thing for a third of a square foot.
Right.
No, I mean, what's rent?
Yeah, I mean, 540 Madison is a building that consistently stays in the high 70s to mid 80s.
That's 540 Madison.
That's 540.
For my viewers, that's 55th and Madison.
Correct, and
Which
340.
before you people bought it was a Class D building, because with the conversion. And how much is rent at the GM building?
Significantly more than that.
I think I noticed in the website you have some space available at $175 a foot.
It goes down from there, yeah.
But $175 a foot.
Which, by the way, is cheap compared to
Thank you.
many international markets.
You go to London,
Right.
Todd's right. We also,
No,
if
that's-
you're talking,
that's true.
You're getting back to asset sales and all the inflow of capital. You mentioned Issathmar and the 230 Park sale. Internationally, we are still very reasonable on a combination of currency
what's
exchange
interesting?
and yield.
Why don't we look at the rents? You know, we're talking about rents in the 20s, 30s, 40s. If you look at the rents in the mid-90s, 98, rents were the same price.
Same.
So we're talking about 8 years later, with inflation, and the cost.
No, rents weren't the same price.
They were lower.
No,
No, they were higher.
They were higher.
On an effective basis.
In certain buildings, the bellwether
Modestly
buildings like a
higher.
General Motors building or like a 9 West 57th Street, and we never got up to those numbers in 540 later on. The top of the market now has really taken off, and as a result of the rent achievement we've had at General Motors, several other buildings within our neighborhood have now
Rod the
pierced
coattails.
the triple-digit barrier.
If someone's paying $700 a foot for 230 Park, you can rest assured that they're not going to be asking $40 a foot for rent.
They can't.
I mean,
Or at least for
they
3
can't.
months of
Right,
the year.
Right. So I mean, there's certain fundamentals that are going to drive rents. Investors are going to start
let's
pushing
go to
rents.
different areas, okay? As I said, last May, this building, which was one tenant in Long Island City, Rexon decides to buy the only office building, I mean, with the exception of the MetLife building, which was a converted Rolls-Royce warehouse. You decided to buy that. Why Long Island City? I mean, I like Long Island City, but why?
I think that it's a culmination. of a lot of things.
Yeah, one building, large
First of
market.
all, look, if you're a real estate investor and you want to have a future in a market, you look at a lot of things other than just the building you're buying. So what we saw there was a combination of tremendous residential development occurring, gentrification of neighborhoods, great transportation, prices skyrocketing in Manhattan.
It's a great building. The pure asset value
it's
is
a great building with phenomenal credit sponsoring the revenue there, and was a very efficient way for us to put $470 million to work that we had sitting around in a very, very tough market to invest in, and make almost an unleveraged 7% return, which has only increased from there.
But you sold 70%.
And then we sold 70% within a year to redeploy that capital into other investments, and made
and some of that was
gain on that.
invested when you bought the GM portfolio, the General Motors in Westchester, at about $220 a foot.
$168
a foot.
Plus.
Here's the interesting point. You bought property for $168 a foot in Westchester.
Which is 30% vacancy.
But it's still $168 a foot. You recently bought property in Westchester for what price?
$150.
$150 a foot. You don't know what those prices. Land in Manhattan is $450 a foot if we can find the land for $450 a foot. You paid $290 a foot for 100 Mall, and you paid $500 a foot for 237 Park Avenue. Prior to the show, I spoke to you, Mitch, and I said, how much would it cost you to build in Jersey City? And you said
about $3.25.
$3.25, and that's a brand new Class A building in Jersey City.
without land.
Including land.
With about a $30 a foot
Including
attribution.
land at a cost of $30 a foot.
But we bought 101 Hudson, which is a trophy building, a year ago for $263 a foot.
And for my audience, what I'm trying to say is today's cost of building a property, the cost of construction, if you had to build a new building, I mean, what you did at 340 was basically you rebuilt the building. I mean,
Pretty much.
was how much a foot?
Similar to the prices that Mitch is talking about. In
330, and you had steel, and you had some other structure over
Yeah.
there. So if you had to buy, I mean, so in essence, what Robert and what you have bought have been great opportunities.
Well, there is another side of the coin, which is the fact that we are saying the rents were similar in New York that they were 9 years ago. In Westchester, we have the same rents now that were 20 years ago.
20 years ago.
So, and I'm not exaggerating. The rents are in the upper 20s now. They were in the upper 20s in 1985.
That's right.
So there is another
What
aspect
goes
of
around
this.
comes around.
Now, the other side of that, at the same time, is the fact that there has been no new construction for those 20 years.
But it's a similar phenomenon in New York. Well, New York, not 20 years, but my $300 a foot construction job at 340 Madison compared to new construction today, which is $700 a foot. So there's a significant arbitrage on that.
Interest rates were a lot higher back then than they are today. So
But I think what Robert said for my audience, 20 years ago, it was the same rent. I mean, over there. I mean, so is Westchester the greatest low-cost alternative, better than Lower Manhattan?
Absolutely.
we see that in a lot of the suburban markets.
And some cycles
depends
change.
on
Like,
what
look at Stanford.
Let's talk Stanford.
Yeah,
You own a
Stanford.
building.
5 years ago, we renewed a tenant at $38 a foot, and today we're talking about rent starting at $28 a foot. So it's 5 years
you have
later,
to
it's
find the
$10
tenant.
cheaper.
That's
you can find
deflation.
it with a 25% vacancy factor in the marketplace.
And
I
what
think
about Greenwich? Everybody wants to be in
And
Greenwich,
Greenwich
right?
is what, $75?
right.
$75 a foot.
But that's an example of brand, but
for-
that's branding. And I think what Wien and Malkin did in Greenwich was take a New York experience and put it to their
Wiener
portfolio.
did it also in Stanford. They took a couple of buildings there, and they're getting $50 a foot for 3 buildings.
I think that what we're saying is that the 6 of us are in a highly competitive industry. Tell your audience that if they want to buy office buildings, that Houston and Dallas are great
Now,
places
wait a
for them to
second.
focus. Stay out of our way. We
my
got plenty
guess-
to do.
I sold $1
My
billion
guest-
worth of real estate.
My
out of
guest had
Dallas
property
and
in Texas. He had property
$1 billion
in Texas. You had
worth of real estate,
Colorado.
right.
You had property over there. I mean, but where are the markets? I mean, what do we think of Brooklyn? I mean, Brooklyn, they've had approval recently for redevelopment for office buildings. It's been rezoned for office buildings.
And they're taking the nets.
One day the Nets will be there. But,
Ken, the Knicks got Steve Francis,
okay,
too.
do we have,
Right,
is
next.
Brooklyn a market? Do you think the other, what's your?
My view on Brooklyn is that I would much rather invest money in, certainly in Manhattan, anywhere, uptown or downtown, or Jersey City, or Long Island City, or frankly Westchester, Connecticut. That's my view.
But
Adam?
who's building the Nets? Who's building the Nets Stadium?
The man who's building everything down there.
Right. And who built Metrotech?
Ratner.
And so don't you think it's a great move to protect and to reinforce that investment
Yeah, but
as this 20-year leases
is,
start to roll?
Ratner is only talking about the Atlantic Yards. I think the other question that we're talking about in Brooklyn is there's 5 or 7 million square feet available for development in other portions of Tillery Street and other markets.
I think
and I
you've
think,
gotta
Robert,
see-
you wanted to once move and look in Manhattan a year ago, 2 years ago, right?
Well, we occasionally look at Manhattan, but I think that the conclusion that we can come to based on what we just discussed is the fact that it's extremely important for one to know the market that is investing in. So even though Rexon is investing in Long Island, they're not interested in Brooklyn. It's a specific market. We are in Westchester, that's a market we know. We are penetrating Fairfield, but certainly takes time until you get full knowledge of the market, until you get to know the rules that apply to that market. Even though we are in a fairly limited area, there are totally different rules that apply even in the city. We are saying that downtown is different than midtown than uptown. So those are markets on its own.
On an aside, on the far west side, when do you, I mean, the New York people over here as opposed to the Westchester?
Well, we have also Fort Lee. You might consider that.
Right. I'm talking about the far west side. I'm talking the expansion of the number 7.
It's the next great area. If the transportation infrastructure comes and when the markets, the commercial markets in Manhattan get to the point where the bellwether institutional users, the large floor plate users need that the only places you'll be able to develop those buildings and have those assemblages will be 9th Avenue, the 30s and the 40s and 10th Avenue.
Those sites were on the brink of development in the last cycle. The rents got to the point where it made sense for justified new construction.
So I'd say that my audience and I have got a pretty good perspective of what the office market looks like in the tri-state region, with ownership of approximately 85 million square feet. Not too shabby over there. I'd really like to thank Mitch Hirsch, Matt Cowley, Real Estate, Robert Wise of RPW Group, Richard Kessler of Benison Capital Partners. We're going around this side. Billy Macklow of Macklow Properties, Adam Popper of Beacon Capital Partners, and definitely last but not least, Todd Waterman of Rexon Associates Realty. Beginning in March, we have this new one-on-one show called Building New York. It airs on March 6th, and that's a very interesting show. And next month, we'll be talking about a neighborhood that you really don't want to invest in. But we're going to have 6 people talk about what's happening in Brooklyn. Thank you.
Funding for the Stoller Report is made possible by a grant from the First American Title Insurance Company of New York. The First American Corporation is the nation's leading diversified provider of business information products and services that impact the major events of people's lives.